We have to work a narrow path in a monetary policy, Bank of England Governor Andrew Daly said today. The central banks in the United States and the European Union are now facing a difficult choice. The regulators are trying to find the right balance between starting to cut rates and fears of dragging the economy into recession. The People's Bank of China made a bold decision today and reduced its interest rate on 5-year loans by 25 basis points. It's decreased from 4.2 to 3.95%, was the first since June 2023, and reached the lowest historical levels. At the same time, the interest rate on loans for a period of 1 year is also at the lowest historical level of 3.45%. Previously this month, China's regulator injected 1 trillion yuan into the country's banking system to support the liquidity of the Chinese currency. The Chinese regulator was forced to take such precedent-setting measures due to sluggish economic recovery and the threat of a deflation. All previously taken measures and promises by the country's authorities failed to boost the demand for loans and turned the decline in the real estate market towards growth. Considering that previously the main driver of its unprecedented rise was direct receipts from foreign investors, China now appears to be in a debt hole. For example, compared with the 2022, foreign direct investment into the Chinese economy in 2023 tumbled by almost 82%. They amounted to $33 billion and reached the lowest levels since 1998. Moreover, in the fourth quarter of last year alone, the profits of foreign enterprises not withdrawn from China increased by $17.5 billion. However, another attempt by the Chinese authorities to support the struggling economy was taken into account by the markets and could even provide some support for the euro. Stock investors in Europe and the US prefer not to take risks while waiting for the minutes from the Federal Reserve. The minutes of the January meeting will be published on a Wednesday, and they will feature the views of the rate-setting committee, so the market will try to grasp the regulators' plans. The Fed's dot plot for this year suggests rate cuts by 75 basis points, and the Fed fund futures markets, as always, go a little further in their plans, and they forecast about 89 basis points so far. By the way, recent statements by representatives of the US Central Bank again turned out to be contradictory. The San Francisco Fed President Mary Daly said that 3 rate cuts are in a reasonable agenda for 2024. At the same time, St. Louis Fed President James Bullard considers it possible to venture into the first rate cut already at the March meeting of the Federal Reserve. The minutes of the Fed's January meeting will be available on a Wednesday. Meanwhile, according to the FEDWATCH tool, only 8.5% of investors expect a rate cut in March. The 10-year US Treasury yield started the holiday shortened week lower at 4.27 and 4.28. Short-term Treasuries sensitive to the funds rate also fell and pulled down the exchange rate of the US dollar. Thus, the yield on a 2-year US Treasuries fell today to 4.59%, and the dollar index is, in relation to its 6 peers, immediately tested the support level of 103.93. Apparently, in the Eurozone, the forced break yesterday tied investors. Hence, today the market responded to the economic data that is usually ignored. The construction sector of the euro area showed growth of 1.9%. Analysts had projected a decline of 2.3%. After its publication, the single European currency immediately went up, considering that the macroeconomic calendar is completely empty, and tomorrow there will be a number of speeches by the policymakers of both the ECB and the Federal Reserve, and the euro will consolidate its success. Due to the bank holiday in the United States on Monday, the trading week for the euro-dollar pair began with a stagnation. However, on Tuesday, the euro opened at 1.0770 and successfully stormed the important psychological resistance of 1.0800. If the euro can maintain its bullish momentum, it could retest last week's high at 1.0805. At 1.0850. Otherwise, this level may be placed back by market participants as resistance, and the peers will again take the instrument in the direction of a support 1.0700. US and global stock indexes have not yet responded to the sell-off in the US Treasuries starting off the holiday-shortened week. US stock futures dropped today. For example, the S&P 500 index fell by 0.3%, and the index opened the New York session lower at 4,985 points. Interestingly, Goldman Sachs analysts upgraded their forecast for the S&P 500 for 2024 and to 5,200 points. Previously, they set a target for the index at 5,100 points, but stronger than expected quarterly reports from the US companies forced specialists to increase their estimate. Strengthening bearish momentum will lead to the S&P 500 to support 4,969.5 or even lower to the 4,928 area. The nearest technical resistance is located at 5,046. As for oil prices, Brent opened on Tuesday at around $83 a barrel. As practice shows, the data on oil reserves in the United States or geopolitical news can set oil prices in motion. US inventory data will not be published until late tomorrow evening, so the main driver of oil price volatility was news from the Middle East. According to media reports, 2 American ships were attacked again off the coast of Yemen. The foreign Brent oil futures once again hit $83.5. If the price stabilizes above this level during the day, the path towards the level of $85 will be open. In the meantime, this line still serves as a key resistance, and you have watched the market review by InstaForex analyst for Tuesday, February 20. Subscribe to InstaForex TV channel and we keep you updated on recent market developments. Don't miss our videos. Your feedback is appreciated. See you online tomorrow.